Hi, my name is Peter Andras. I am a professor at Edinburgh Napier University. This is my lecture series on the evolution of complex systems. This is lecture 9, Economics and Money. This is part 2 of lecture 9. So, in this part, we will look at identity violations and adaptations in the economy. We look at organization in the context of the economy, how we define them, how do they work in the context of our systems theoretic view of the economy. And then we look at banks and the monetary system as a core of the system of the economy, which defines the identity of the economic system. Now, in the previous part of this lecture, we discussed about the economy, and we said that economy is the system of exchange communications, where humans exchange human artifacts. And in particular, we said that in most modern societies, these exchanges use a particular exchange, universal exchange good, which is the money, and artifacts are exchanged for money, and then money is exchanged for further artifacts. So let's have a look at how are identity violations and identity definition in the economy. So, as we said, that the memory communications within the economy are expressed in terms of money. The records, the accountancy records, both in terms of flows and stocks, are expressed in terms of money, and operations over these memories are analysis of money transactions and money valuations of goods and services. So the money serves as the memory communication unit within the economy. And consequently, the identity definition subsystem of the economy, it is the system that defines how money transactions work in the economy. So the definition and regulation of money within the economy defines the economy. Now, this definition and regulation in earlier societies happens in less formal ways. However, in modern societies, and in fact in most other societies for at least hundreds of years, if not thousands of years, this definition and regulation of the money happens by the legal system of the society, by decisions of the political system of the society about what kind of legal definitions and regulations apply to money. So in this respect, the identity of the economy reflects the overall identity of the society as well. Now, if you look at identity violations, of course you find faults like fake money or error situations where unwanted goods are produced. So the company may produce a lot of cars, for example, which cannot be sold on the market because the taste of the buyers has changed and they no longer want those kind of cars. So the exchange communications which lead to and support the production of cars happens, but then the expected continuations of selling these cars does not happen. And of course you have the failure when inflation goes into hyperinflation, where there is very high inflation, as we noted in 1920s Germany or 1990s in Brazil, where the changes in the valuation of the money are rapid and unpredictable, and that leads to the collapse of the economy and effectively the potential disintegration of the economic system. And generally, the response to these violations of the identity of the economy are adaptations in the economy. So, for example, having fake money in the economy can be adapted to by having better rules about valid money and punishment for using fake money, so that discourages the using of the fake money and the distorting effects that might be caused by having fake money in the economy. In the case of a company which produces unwanted goods, they can implement new checks, for example, better market research, better product design, to make sure that the products that they produce can find buyers for them as well. And in the case of the hyperinflation, really the solution is the resetting of the economy by the introduction of a new currency. So, for example, this happened in Brazil or Bulgaria or Argentina or Germany when they had hyperinflation. The central bank sets a new currency. There is a political and legal decision making and legal rule set which sets the new rules for the new currency, where the country aims to keep the new currency without inflation. And if this commitment is delivered, then a new economic system is set up, if you like, using a new currency. Of course, the same economic system works, however, the core of it, which becomes a new currency. Notably, in some countries where hyperinflation is experienced, the introduction of new currency is done effectively by adopting a foreign currency. For example, it happened in Zimbabwe or in Ecuador in more recent years, where the inflation led to the deterioration of the value of the previous currency. And because there were insufficient conditions to introduce a stable currency which would not be deflated, the simpler solution in these countries was to adopt, for example, the US dollar as a currency until a new local currency is created and introduced. By adopting a foreign currency, clearly they eliminate the way of printing new money because it is not their own money, and that has a stabilizing effect on the economy by making the transactions more predictable, the prices more predictable, and that recreates the economy in these countries. Now, as we noted earlier, if you have a growing society, that needs a growing economy. And to have a growing economy, you need some small level of inflation. You need a growing economy in order to support the growth of a society. So without a growing economy, a growing set of artifacts that supports the growth of the society, it is unlikely that society can grow. Now, the growing economy needs a small inflation. And the reasons for this is that, in general, it is very difficult to predict how much growth of the money supply is needed to provide sufficient money in the economy for the growth that is being delivered. Now, the problem is that if there is not enough money provided within the economy, then there is a potential for growth. However, that growth is not going to be delivered because there is insufficient money to fuel those transactions. So, on one side, you need to have some growth of the money supply within the economy to support the growth, but it is impossible to predict exactly. And if there is not enough money, then the potential growth does not happen, and that may turn into a shrinking of the economy. So the solution to this is to provide slightly more money than what is expected to be needed. So in effect, this leads to a small inflation that is needed for the growing economy. If there is no inflation at all, that indicates that possibly the economy is not growing enough. There are potential growths that are not happening in that economy. If there is too much inflation, that impacts negatively the predictability of the prices, the predictability of the economic transactions, and that predictability creates more uncertainty in the decision makers, and that leads to the avoidance of some of the potential growth-leading economic transactions that are judged to be too risky and too uncertain by the decision makers. So neither deflation, the shrinking of the money supply, or high inflation is useful for the economic growth, but some small moderate level of inflation in general is needed in order to support the growth of the economy. Now, so far we discussed about the economy and we mentioned organizations in general which produce goods and services. And let's have a look at organizations. So in general, organizations are sets of human communications which follow a set of constraints. So these are the rules and regulations of the company or of the organization, which tell you how people should behave in the context of the organization, who are the members, who should do what, and how the organization works. Now, the organizations within the society are regulated by the legal system of the society, and these regulations represent decisions of the political system. So again, organizations, the kind of organizations that are in a society, be them companies or civic organizations, these reflect the identity of the society. So in a society, you may have companies. For example, in a modern Western society, you have many companies owned by individuals or groups of individuals, reflecting the nature and identity of this society, while in another kind of society, let's say in a communist society, you don't have many privately owned companies. There are companies, but these are all state-owned and they all follow the planned economy, and the individual's involvement is only through working for a company and not by owning company. So the two kinds of societies have different kinds of companies, and these different kinds of companies operate differently in these societies, although in similar ways, but they are with significant differences. Now, in the economy, the production of goods and services happens in the context of organizations. Now, in some cases, to some extent, individuals may produce goods and services as well. However, in general, in most cases, the production of goods and services happens in the context of organizations. In earlier societies, these organizations might have been much smaller than in today's societies. For example, a potter might have worked with their family to deliver their goods as a relatively small organizational unit. However, today most of good services production happens through organizations. Of course, there are still exceptions. For example, painters may paint their paintings without being in any particular organization beyond themselves. Now, organizations themselves include a large extent economic communications. So if you look at how an organization works, it involves a number of people who do deliver some work. Now, if you look at what this work is, it is communications with other humans and certain kinds of behaviors which impact on the environment or on parts of the environment. Think about making cars or making shoes. The materials are turned into particular forms. These are put together in certain ways, which ultimately leads to the production of these goods. The way how these are produced involve a lot of human communications. However, one particular kind of communication involved here is that the individuals, the humans, which are contributing to the organization, they get paid for their work. And these payments and economic transactions within the organization form a economic core of these organizations. So there are goods and services within the organization which are transacted, which are exchanged. There are there is an accounting of what kind of stocks and flows happen within the organization. And all these are measured and recorded, mainly in terms of economic communications, in terms of exchanges of goods and services for money, and the registering of stocks and flows in terms of money. Now, larger economies, larger societies rely to a larger extent on organization for the production of economic communications. If you look at organizations, of course, we said that they have their own rules, and these rules provide their structures. So the structures effectively are constraints on organizational communications. So, for example, if you look at the university, it has a number of departments delivering certain programs, certain services. If you look at the company, it has a marketing, sales, finance, and other HR departments, and so on. So there are structures, and these structures express constraints within the organization, which constrain the organizational language. And in some cases, these structures may generate subsystems within the organizations, okay? Sub-organizations within the organizations. How the organizations operate, they process the information about themselves. They need memories, and these memories of organizations are the records of the organizational communications. In the context of the economy, we are focusing really on the records of money values of stocks and flows, what happens within the organization, what money exchanges happen that lead to or support the production of goods and services within the organization. And these records are sort of the accountancy records of the organization. Now, in general, the records of the organization, of course, include all other communications and records of communications like reports and analysis of data about the organization. And the communications about the memories form the information subsystem of the organization. And this is really the management of the organization. And management communications define the identity, they check the identity, and enforce the identity of the organizations. And these are generally expressed as the rules and regulations of the organizations. A particular part of these management communications deals with the money-related communications, it's the financial management of the organization, which is the relevant part of management in context of the economy. Now, in the context of organizations, again, you can see faults, errors, and failures. For example, errors in the accounting, in numeric errors, wrong accounting statements. These are faulty communications and they need corrections. The errors are, for example, the production of goods that cannot be sold, as I mentioned earlier. And in the case of failure, we have the bankruptcy, where the organization is unable to pay for goods and services that they need to produce their own goods and services that they sell. So if they cannot pay their due payments, then the organization ends up in bankruptcy, and that is when it is declared unable to pay. Now, in response to these identity violations, of course, organizations adapt. So in the case of the wrong accounting statements, wrong calculations are corrected, and a new accounting statement is produced in order to correct this error. If there are issues with selling goods and services, better market research can help to understand better the market, and the organization may introduce new rules about how market research should be done and how that should be impacting the product design and production. And in the case of bankruptcy, the organization may get restructured, reorganized, it may sell some parts, or it may merge with another organization to restructure itself and establish a new financial identity for itself. Now, in the context of the economy, what you see is that the organizations really are about exchanges of goods and services for money. So they need money to reproduce because they need money to buy goods and services that they need to produce their own goods and services. They need to hire their staff, and they exchange money with these staff who produce their work in the context of the organization. Now, as the organizations grow, they usually grow by increasing their available money amount. Now, this growth in money terms can get quite complex. Organizations borrow money, and they also spend their money on various projects. So, on balance, an organization might be at various positions monetarily where the balance of their commitments for their loans and against the balance of their incoming uh, incomes from various sources of selling their services and goods may balance in various ways, from very low to very high positive balance, possibly negative balance. However, overall, if you look at the available money, the cash flow of the organization of what they have available at that time, if the organization is growing, this available money is growing over time. And effectively, the growth of the organization can be measured by measuring how much of their available money is growing, or their money balance, how it is growing. So this leads to the concept of profitability, and in the context of the economy and in the context of economic organization, the profitability is the key factor which determines the growth of the organization. Profitability is the balance between their costs and revenues, and if the revenues are higher, then the organization is profitable, and that means that it is able to grow their available money amounts, which they later invest and spend. However, at any time, what is available that helps the growth of the organization, and thus being profitable, it is a key feature for economic organizations. So what you can see here is that we paint the organization as a machine which takes money in, processes money inside, and then generates money outward. So this money is paid, for example, to the owners of the company as dividends. So this leads really to the profitability as the key criterion of the success, which is the reproduction and expansion of the organization. So those organizations which are highly profitable can reproduce and expand much more than the less profitable economic organizations. Now, the organizations compete in the context of the economy for economic communications with the potential clients. And this competition is really in terms of profitability at the core. So those organizations are the winners of the competition. Those are the ones which outcompete others, which are more profitable than other organizations. Now, there are particular organizations which deal with money. So as you said, the money is the core of the economy. It is kind of memory communication unit within the economy that is used to record economic communications. And it is this universal exchange good within the economy. Now, the organizations that deal with the money are special organizations within the economy. In the early times, it was the mint which produced the coins for the rulers, and the political leaders, the rulers, decided how they produce their coins in the mint in order to fuel their economy. Now, at those early times, there were many kinds of coins in circulation. Different states, different societies had different coins with different values. And the specialist money traders were the coin exchangers who would know the valuations of different silver, gold, and other kinds of coins, um, and who would be able to do these exchanges and facilitate the exchanges for people who were involved in trading across different societies. Now, this led to the formation of the early banks, which would store money and would facilitate the exchanges between different kinds of money and would also potentially lend money to people who would need, or to organizations who would need the money. So that leads to the development of the banks, which are these very specialist organizations which are specializing in the exchange of money and recording of the money exchanges on behalf of humans and organizations. So their particular role within the economy is to generate the memories of economic communications. Now, as you said, individuals and companies generate their own memories through their own accounting. However, the banks provide kind of generalized management of memories of economic communications, which involved the money exchanges within the economy at a large scale. The banks also generate communications about the memory communications of the economy. These are communications that are recorded in terms of money. For example, you may think of analysis of loans, evaluation of creditworthiness, credit scores, and so on, which analyze how money is managed by individuals and organizations within the economy, and these kind of analysis of memory communications of the economy lead to further communications within the economy involving money. So, for example, banks may decide to lend to a company and may decide to not lend to another company based on their analysis. These, like the commercial banks who do interact with individuals and organizations within the society, consider primary information subsystem of the economy, because these deal with the processing of memory communications within the economy. Now, the banks set their interest rates that applies to their loans and their deposits. The banks take deposits from individuals and companies where people can store their money, and they pay a fee, an interest, in exchange for keeping their money. And they also charge interest rates for loans by facilitating other people or other companies who may need money to invest into growing their businesses by lending money to them. So on one side, the bank takes the deposits, on the other side, it lends this money and sets the interest rate for both kinds of activities, which are the fees, again, payable in money terms. And in this way, the banks provide a multiplicator effect in the economy, because they can lend the money taken through deposits to clients and effectively increase in this way the available money in nominal terms, since they owe to pay back the money to their depositors, but because the depositors don't effectively use all this money at all time, so they don't necessarily ask for the repayment very soon, the banks can lend the available money and trade the money in this way over time by taking it at one point, lending it, and then taking back the payments for the loan together with interest from the company which took out the loan, and then possibly paying back the depositor when the depositor asks for some part of their deposit. So in this way, the banks perform multiplicator effect, and the extent of this multiplicator effect is regulated by the legal context, the legal regulations which are applicable to banks. So in this way, banks create this bank money, which fuels further the growth of the economy. And this is a really important step in generating further growth in the economy. So on one side, having money as a universal exchange good helps the standardization of exchanges and the growth of exchanges. But having banks in the economy can further multiply the available amount of money over this temporary trade between depositors and organizations which take loans. And so this way, the banks generate the bank money. Furthermore, more recently, electronic money has been introduced in several countries, and the electronic money is replacing the paper money to a good extent. Now, in some countries, the electronic money is actually replacing paper money to a very large extent. And that creates further additional ease and support for the growth of the economy. Because electronic money now exists through the services of the banks, through the maintenance of the bank accounts, and no longer requires the production and issuing of paper money and coin money that would be used in the economy. So it reduces the cost of maintaining the monetary system within the economy. Also speeds up the transaction, so speeds up the velocity of the money through the economy, which again creates more money in the economy and fuels potentially more growth of the economy. Now, one particular kind of bank is the central bank. In the early stage, central banks and banks were just the same. These were the mint, where money was minted. However, in current economic systems, quite often there is a central bank. The earliest central bank was created in Sweden, and then shortly after, England and Netherlands followed, and other countries followed as well. This happened around the 16th, 17th century. Today, you may look at the Federal Reserve System in the US or the Bank of England, which are the central banks. Now, these are really very special organizations. These are the most special banks. The central banks are the banks of the banks. So the central bank is interacting with other banks, taking deposits from other banks, providing loans for other banks. They do not interact with other organizations other than banks. And the central banks are the ones who regulate the money supply in the economy by regulating the base interest rate at which they lend money to banks, and regulating the reserve requirements, which is the regulation of how much of their deposits commercial banks may lend out to organizations and individuals. The central banks also regulate the validity of money and rules of the currency exchanges with other currencies. So in this way, the central banks really define the core identity of the banking system and of the monetary system. So overall, the information subsystem of the economy can be seen as the commercial banks plus the central bank. And the central bank is really at the core defining the identity of the banking system, which in turn defines the monetary identity of the economy overall. So the central bank analyzes the economy, how the monetary transactions work in the economy, and on the basis of this defines the identity of the economy by defining the currency, rules related to currency, and rules related to the management of the money by banks. And the commercial banks provide, in addition to this, the analysis of their segment of the market, set local rules, loans, mortgage, interest rate, and so on. And in this way, they provide the core of the information of the economy in their segment of the market. Now, the fiscal regulations are the rules set by the state which regulate the money values of the state services and procedures of implied money exchanges. So these are the fees for judicial processes, fees for administrative processes, like getting a driving license, getting a passport, paying for legal fees, for example, when you buy a house, and so on. So all these fiscal regulations effectively set the price in money terms, in money value terms, for the services provided by the state, including the taxes that are payable after income, taxes that are payable after wealth, and so on. These are taxes, tariffs, fees, which in general provide the income to the state. Now, clearly, the state, as we said, that is some of all institutions that support the political subsystem of the society. And in order to make this political subsystem work, it needs money, income, and that is generated by fiscal regulations, which are effectively overall, if you like, kind of tax on the overall economic system, which tax is there to support the political system. It's the state institutions which provide the political context and then decide the legal context of the economy. Now, the fiscal policy is within the state is the policy which sets the taxes, fees, and other income elements for the state. So this is how the state, using the political power, sets the rules about providing money for the services that maintain the state. The monetary policy, on the other side, it is set by the central bank, and it is the identity definition, identity checking, and identity enforcement communication for the core of the economy. So this sets out how the money supply in the economy works and defines the identity of the economy in this core sense. Now, if you look at the complexity of the economy, of course, what you see is that hunter-gatherer societies, there's a small complexity. It mainly involves direct exchanges of goods and services. But if you look at societies which use coin money, paper money, and electronic money, increasingly you get a more complex society. By having money, you have many more economic communications, economic exchanges, so that grows the complexity of the economy. Having paper money, or in general kind of convention-based valuation for the money, that again grows the economy because it is not constrained by the production of precious metals, but it is constrained by what is needed for the economy from the perspective of those who set the value of the paper money. Moving to electronic money, as I said, it adds an even further growth element because it can increase the velocity of money through the economy. It also reduces the costs related to maintenance of the monetary system and of the money within the economy. And then having a banking system, it's further complex because it fuels further growth in the economy, and having a central bank which provides kind of core anchoring of the commercial banks, providing more stability for them, improves the stability of the banking system and improves again the predictability and the growth potential of the economy and leads to even more complex economy. So in general, more expansion you have, more complexity you get in the economy. We noted that high inflation is damaging to the economy. And generally, high inflation makes economic transactions less predictable. So all the good things in having convention-based money, banks, and the central bank, all these benefits can be undermined by high inflation because that increases the unpredictability in the economy, and as a result, a number of economic communications will not happen, and that leads to the shrinking of the economy and reduction of the complexity. Similarly, deflation also decreases the complexity of the economy because it limits the potential for growth, and some potential growth doesn't happen because of the lack of the money supply within the economy. Now, in general, decrease of complexity leads to shrinking of the economy and implies also shrinking of the society. In summary, we looked at identity violations and adaptations in the economy. We also looked at how these variations and the corresponding adaptations leads to changes in the economy. Now, in particular, we looked at inflation and impact of high inflation and deflation in the economy, and we noted that in order to grow, a society needs in general, it needs some small level of inflation, but both higher level of inflation or deflation, the shrinking of money supply, are damaging for the growth of the economy. Then we discussed about organizations. We saw how organizations are structured communications, human communications within the society, and how organizations can be seen in the context of the economy as organizations which take in money, process money, and generate money for their owners. And we said that in organizations, for this reason, in all economic organizations which are mainly active through the economy, the profitability is the key factor which leads their competition with for clients and for communications within the economy. Just know that there are other organizations as well which are not economic organizations, these are still part and still take part in the economy, like community organizations, but their criteria for growth and competitiveness are somewhat different. Clearly, economic aspects of these organizations matter, but the way how they generate their income, their money, revenues, is different from the usual economic organizations. Then we discussed about the banks, which are particular kinds of organizations which specialize in dealing with money, recording money transactions, taking deposits of money, and providing loans to organizations and individuals. We said that having banks improves very much the growth potential of the economy. And then we discussed about the central bank, and we said that this is the core of the banks, the bank of the banks, which deals with only banks, provides stability for the banking system, and also provides the setting of the identity of the monetary system of the economy, and essentially the core of the identity of the economic system, by regulating interest rates, by regulating the minimum levels of deposits that banks need to retain, and so on. We said that the information subsystem of the economy is provided by the central bank and the banks together. The central bank provides a core of the information subsystem and the identity definition of the economic system, and the banks provide further parts of the information system and identity definition. We discussed about monetary and fiscal policy. We said fiscal policy is a way how the state sets its fees to generate its income that is required to support the delivery of the state services. And the monetary policy is set by the central bank, which sets the identity and changes in the identity of the economy. For example, changes in the interest rate of the central bank that is charged to banks which take loans from the central bank. And finally, we discussed about the complexity of the economy, and we said that those economies which have money, convention-based money, possibly electronic money, banks, and central bank, are increasingly more complex, and the complexity of the economy grows with having these institutions and organizations. We also noted that inflation and deflation reduces the complexity of the economy and also reduces the economy, leading to shrinking of the economy. Yeah, let's have a few questions and answers. First, is the money a memory communication unit within the economy? And essentially, that's what we said, that you can see the money as the as the medium of the memory communications within the mind. So all memory communications, all records of economic communications ultimately are recorded using money terms. Of course, there is also records of what is actually exchanged, what goods, services are exchanged, but the money aspect is always there, and it is a core element of the memory communications. Second, is it true that inflation is caused by large amounts of fake money? Now, the answer is no. Fake money can be disturbing, potentially could lead to expansion of the money supply temporarily, but in general, fake money is detected and removed from the economy, and in general, it is not produced in sufficient amounts to cause any inflation. Next question. Is it true that hyperinflation usually is handled by redefining the identity of the economy through introduction of a new currency? And yes, this is true, and we gave a number of examples of countries which experience hyperinflation. This is when the inflation becomes very large, the changes in the valuation of the currency becomes very unpredictable, and the changes are very large. And in such cases, the economy collapses. Because the economic transactions become so unpredictable that, for example, the price of a piece of bread might change, might double or triple within a day. So the use of money becomes impractical. In such case, the economy collapses. And the key way to restart these economies is to redefine the currency by reintroducing a new currency. In these economies. In some cases, the new currency is the currency of another country, which does not inflate, and in that way, it can be used and kind of inflation-free new currency in the country. Next question, is it better to have zero inflation than to have a small positive inflation? And the answer is no. As we discussed, in order to have a growing economy in a growing society, and to support the growth of the society by a growing economy, you need to have some small positive inflation. The reason is that it is impossible to predict how much growth of the money supply is needed to match the growth of the economy. If it's too little, that's not good. And you need to slightly over predict the growth of the money supply compared to the actual growth of the economy in order to not cause deflation, which would damage it. So aiming for zero inflation is practically impossible, and the better option is to have a small positive inflation. Next question, is it better to have negative inflation, deflation, than to have high positive inflation? And well, the answer to this is that both of these, negative inflation, deflation, and high positive inflation, are damaging to the economy. In both cases, in the case of deflation, you have potential economic growth that does not happen. In the case of high positive inflation, you have high unpredictability, high uncertainty in the economic transactions, which limits the number of these transactions that can happen. So both are leading to shrinking of the economy. However, in general, deflation does not damage the predictability and trust within the economy, while high positive inflation does. So the negative impact of deflation is likely to be shorter than the negative impact of high positive inflation. This is generally a reason when countries experience high positive inflation, let's say around 10% or above, they often opt for the generation of deflation by shrinking money supply in order to prevent the further growth of the inflation and resetting the inflation expectations of companies and individuals such that the country can return to a small positive inflation. However, there are also examples, for example, Japan in the 1990s and 2000s, where zero inflation or net deflation happened over a long period of time, and the understanding of this deflationary zero inflation period is that the country did not manage to deliver some of its potential growth because of the deflation that was experienced in it. Next, are organizations formed by a set of constrained economic communications? Yes, the answer is yes. This is how we define organizations. So these are formed by constrained economic communications set by the rules and regulations of the organization. Next question. Is it true that the criterion of profitability in the context of competition of firms is implied by the need for growth of the society? So what we said is that firms, economic organizations, compete for economic communications for their clients. And this ultimately leads to the criterion of the profitability as the key criteria for the competition of these firms. And this is indeed implied by the need for the growth of the society. In order for the society to grow, you need a growing economy. And within that growing economy, you need growing firms. You need to have growing firms, they need to be profitable. So profitability in this sense, it is implied as a criterion for the competition of firms, is implied by the growth of the need for growth of the society. Next question. Is it true that commercial banks increase the money supply by printing more money? And the answer is no. The commercial banks do increase the money supply by taking deposit and providing loans, but this does not happen by printing money. It is happening by the temporary trading of the money that is taken from the depositors who do not need at that time to have access to their money, and the lending of this money to companies and individuals who need the money to use it to grow their company, to generate more services and goods. For example, when somebody takes out a loan to build a new house, that generates more economic communications with all the providers of the building services and all those who provide the building materials. So in this way, banks do increase money supply, but they do not do this by printing more money. Finally, can we consider the central bank as the core of the information subsystem of the economy? And the answer is yes. This is what we said, that the central bank is the bank of the banks. This sits at the middle of the banks, providing loans to the banks, providing also the setting of the monetary system by setting currency, exchange rates, deposit, the rates for the interest rates for the loans for the banks, and so on. So in this way, the central bank is really sitting at the core of the information subsystem of the economy. Thank you.